Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bonds investors. I'm Dan Barnes. Crossing trades internally can save a huge amount of money for investors, however it's fraught with complexity. We're speaking with Cathy Gibson, Head of Dealing at Royal London Asset Management, James Wallin, Senior VP at AllianceBernstein, and Dan Hinxman, Global Head of Institutional Sales at TrueQuote, to learn how the buy side can deliver best execution through crossing at a lower cost. Cathy, James, welcome to Trader TV.
Thank you, Dan. A pleasure to be here.
Nice to be online with you.
How does an internally cross trade differ from a market-filled order?
We have two funds who are buying and selling the same bond, and instead of going out to the market and buying and selling those with liquidity providers and paying full bid offer spread, we cross them between the two funds. Post MiFID II, this means that we have to do it externally via a platform.
And how would you compare the quality of execution you get with an internally cross trade versus a market trade, Cathy?
So the quality of execution is much better on an internally cross trade because we trade at mid. So both the buyer and the seller of the fund benefit from mid pricing as opposed to paying bid offer spread. So essentially it's cheaper for our funds.
And so clearly there's the need to capture the opportunity and then the mechanics of actually enabling that cross. What do you actually need on a trading desk in order to enable that to happen?
So you need a strong order management system that can actually identify crossing opportunities among a large trading blotter full of trades.
Okay.
Once you've identified them, then you need to have a venue, an OTF, whereby you can actually go out onto the platform and cross those trades at a mid-price, usually determined by some sort of composite price.
Because there's the potential for one to get a mismatch unless you're very careful on that.
Exactly. We don't want to favour one fund over the other fund.
And James, how do you see that process being enabled on the trading desk and how does that regulatory element creep into that?
Well, I think as Cathy mentioned, you need to flag the opportunity first, but then you need to have a methodology for identifying what the reason for selling on the one side is and buying on the other side is. Actually, the selling is more critical usually to understand that you're benefiting both clients. Examples are a cash flow where a client has to sell certain securities and yet they're still deemed desirable, or a situation where there's been a rating or other change in the character, ratings downgrade or another change in a characteristic of a security that forces a client to sell an otherwise valued investment opportunity.
Because you can take out the spread, so that in itself is a quantifiable value, isn't it?
When you're trading at the mid, assuming that both sides are benefiting from the trade, you're clearly adding value because you're eliminating the cost of the spread.
Yeah.
What that is differs on a trade-by-trade basis.
The other non-quantifiable bit is actually the fact that you're doing a trade and you're not allowing information leakage into the market.
Sure, so there's no market impact effectively.
So there's no market impact, correct.
Right, okay. Are there any barriers to making a cross?
Barriers to making a cross would be lack of pricing transparency. So where you're trading a super liquid bond and you can't actually find evidence of where the fair value is, that becomes far more difficult. Ironically, they're usually the best opportunities for crossing because the bid offer spread is going to be the widest.
Yeah.
So you have to put a lot of groundwork into evidencing your rationale and the pricing for those kind of trades.
Okay, so that has to really be built into the best execution methodology.
Absolutely, and involves working between portfolio manager, trader, and sometimes compliance to agree that the level is appropriate for the client, both the buyer and the seller of the fund.
How are these challenges being overcome at the moment? Cathy, would you like to start?
I think there's some really good platforms out there now which have come on board, particularly in Europe, to allow us to do that, to cross trades. And also, I think the quality of the pricing and the composite pricing that we have for bonds has really improved in the last number of years. So where we see a mid-price, our traders have to challenge the source of that mid-price far less than they used to have to do.
In the States, it seems that the rules are slightly more stringent on crossing trades. Is that actually a barrier to enabling crosses?
The problem, as I alluded to previously, is that the regulatory framework here hasn't caught up with the science of crossing or the art of crossing. And, we need to get the SEC to recognize our ability to use pricing service prices. And we need to get them to recognize that there's a cost here that is appropriate, which shouldn't be considered a commission if you use a platform that allows you to set up, document, and clear your cross.
Are end investors showing interest in crossing trades, and is there a way to show the benefits to them?
Yes, they are showing interest in cross trades. They will show interest in anything that adds alpha to their fund, and cross trade certainly does that. In terms of showing the benefits to them, they can see that in their trading cost analysis.
I think the key with crossing and describing crossing as part of a comprehensive trading strategy is to make sure you emphasize that it's being done for the good of all clients. And, that's in the context of the U.S. regulatory environment again, where there have been a number, including recent situations, a number of issues with crossing and regulatory sanctions being applied for improper crossing.
That's great. James, Cathy, thank you very much.
Thank you.
Now Dan Hinxman, Global Head of Institutional Sales at TrueQuote, will give us his insight into how to make crossing effective. Dan, welcome to Trader TV.
Dan, thanks for having me here.
So can you tell me, why do clients need to cross trades internally, and what are the challenges they face in managing that process?
They're quite at liberty to trade like any other directional trade that they have within their order staging in the open market. But I think what we've seen over time is asset managers have seen significant efficiencies of conducting these internal, or identifying these internal crosses and executing these internal cross trades. And they've seen huge efficiencies around best execution and TCA, as well as operational advantages. And I think as well as those being efficiencies and advantages, I think they also present certain challenges as well.
Okay, so what are those challenges and how do they need to be overcome?
The asset manager has the responsibility to meet the fiduciary duty of the underlying investor. And I think what makes this a unique situation for in cross-trade situation is that they have to do that at least 2 times over for the underlying investors.
Right.
And to consider all of the factors for both parties. And that's both from a best price perspective, that's also from completing the trade with the minimum amount of slippage for the size of the trade, and also from the minimum amount of disruption to that market, because obviously the asset manager may have a residual portfolio position to protect in a particularly illiquid instrument, and the last thing they want to do is move that market away from a fair price point.
And what do you have to have on the trading desk itself to enable this process?
Well, I think firstly, the asset manager needs to build into their best execution policy, whether that's an internal document or a client-facing document, or even a publicly published document, that they have a cross-trade policy, internal cross-trade policy within their best execution. And once they've done that, they need to be able to efficiently identify where cross-trades do occur. That normally happens in their order management system, in their order staging. And that needs to be done in a timely and efficient manner to allow them to conduct those trades as necessary. And then after that, they need to implement the process that they've chosen that best meets their best execution policies. So that could be their own internal measures, or that could be a platform like TrueQuote's cross-trade, where they have a number of those factors that are considered for them in that process.
Does the size or the type of asset manager affect whether crossing is more viable?
I think if you take the whole scope of the broader buy side, very much so. So if you take a sovereign wealth fund or a hedge fund, who typically, when it really boils down, they tend to just be managing all of their trading activity to 1 or 2 or 3, a handful of funds, there's less of a need to cross internally, or less occurrence of where that might happen.
Sure.
Where if you take a very large asset manager who have hundreds of funds to manage in portfolios, the likelihood that there's going to be inflows and outflows, and also different types of trades. So, you're going to have your typical risk-on, risk-off trades that come through the execution desk, and at the same time, you're going to get redemptions and daily and monthly rebalancing, particularly if they're index-linked asset management.
So how far along are buy-side firms in making that change?
I think they're a fair way through the process, actually. I mean, most asset managers have adopted a internal crossing policy, whether that's both localized regionally or globally, and there are nuances to the view of crossing trades internally globally, and how they then have implemented their strategy over the top of that. Maybe an adoption of a platform like TrueQuote, or having their own internal process where they've satisfied their internal compliance and regulatory requirements.
What are some of the operational issues?
So I think the asset manager needs to make some considerations about operations, and that tends to start from things like consistency. Whatever they implement as their best practice for crossing trades internally, can they replicate that process time and time again to demonstrate that they're treating all end investors the same, day in, day out, regardless of market conditions?
Okay.
And I think also from an audit perspective, from an operational perspective, they need to have the processes perhaps within an electronic workflow, so it's very easy to audit and the information's at hand. Should there be some sort of query around that trade in days past the trade? Sure.
So that takes the workload pressure off the trader to manually record all of that.
Yeah, absolutely. And simply from a scalability point of view, we're not just talking about 1 or 2 trades a day.
Of course.
These asset managers, quite often, we're putting through hundreds of line items in a particular day.
Yeah.
So it could be a very laborious process if they're having to do that very manually using another protocol like RFQ or bulk uploading to a particular dealer and then having to do it 2 or 3 times over to make sure that they've got the best price between 2 or 3 dealers. You can see in that process there's a lot of sharing of information. It's a long process and it could be rife with human error, but by having it in one simple electronic workflow, it's very easy to keep a track and make it a very scalable process day in, day out, and also globally. So if you've got an execution desk based in London, it's very easy for their APAC or their US desk to replicate exactly that same process.
Okay, and what is it you see spurring them into using internal crossing?
Certain asset managers have taken their policy around internal crossings and championed it to their end investors as a way of demonstrating their best execution and the cost savings associated with internal crosses. So I think if we see more and more of that, I think that will be championed internally, that becomes a sort of steady process within an asset manager.
And finally, the TCA challenge, the transaction cost analysis challenge in fixed income, has always been massive. Do you think it's easier to evidence best execution from an internal cross than perhaps it might be with a market trade?
I think it faces the same challenges.
Right.
I think from a best price point of view, you can't look at all of these parts of TCA independently. They're intrinsically linked, from the best price, the slippage of a trade, and the best outcome for the investor over a period of time and the size of the trade, etc. So I think you can look at it in all of its different component parts, but ultimately what is nice that when you've got the process in place, it's easy to reflect on that through an audit process and be able to see why you made decisions and you were consistent in the decisions you made to carry out the execution.
That's great. Dan, thank you very much.
Thank you, Dan.
I'd like to thank Cathy Gibson of Royal London Asset Management, James Wallin of AllianceBernstein and Dan Hinxman of TrueQuote for their insights into crossing trades, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.